In the past few weeks, there's been some chatter about whether the Canada Pension Plan, a CPP, needs an overhaul. This article from Andrew Coyne in the National Post specifically caught my eye when he unpacked CPP's recent performance and its related costs. So if you're planning for your own retirement, it's a question worth exploring. And here's the wild thing though. It turns out an American beer company, of all things, way back in the 1980s, might actually hold the key to solving some of the issues that we're facing today with CPP. So in this video, I'll dive into a fascinating case about what Anheuser-Busch did 40 years ago when they faced a similar dilemma with their own pension fund. You'll see that by comparing their novel solution back then with CPP's current challenges they're facing today, you'll actually learn some pretty valuable insights about how you might be able to use modern evidence-based investment strategies to offer better solutions as you think about how to plan for your own retirement. So what are the challenges with CPP, and are they being overstated in this crazy headline? Well, let's take a closer look, right? Because despite its crucial role in providing retirement security for millions of Canadians, the CPP investment board's actually been grappling with some pretty serious issues. In their most recent 2024 annual report, which is an 80,000-word kind of narrative on what happened the previous year, they highlight that after deploying all of their sophisticated investment strategies, they were able to squeak out an 8% return last year. Now, 8% might seem like a good number, but it's actually pretty wild considering that markets were up massively last year. So to not earn a solid return, you'd really have to kind of mess up to not capture that sizable return. And here's the thing. The fund's own reference portfolio, which is kind of a blend of a global equity and bond indexes that they use to evaluate how well they're doing, it gained 19.9% last year, that same year. So the reference portfolio did 19.9, and their portfolio did 8%. And they even admit this themselves, that the fund would have been better off by mimicking this basket of publicly traded securities, essentially taking a lower cost, passive approach versus the 80,000-word sophisticated and expensive active approach that they were implementing. Now, if this was just a single year, maybe a one-off event, you could shrug and say, oh well, that journalist Andrew Coyne did the good work for us, and he dug a little bit deeper, and he highlighted on page 39 of the report that they themselves confessed to having earned a negative 0.1% annualized, or negative $42.7 billion since the inception of this active management approach back in 2006, relative to that reference portfolio, which they themselves create as kind of the benchmark that they want to be evaluated by. Now, this is a tiny percentage difference, but it has a massive dollar impact, right? Even here on page 31 of the report, we see the strategy has cost them between 1.2 and 2% over the last 5 years. This is a crazy, if not predictable, result. It's not unexpected because their outcome is just like all the other parts of the investment industry who pursue a similar approach. The math, right, the evidence suggests that on average, while some of these strategies absolutely can outperform, the overwhelming majority do not, across all asset classes and across all geographies. This here shows the percentage of underperforming, actively managed Canadian domiciled funds across all of those asset classes and time horizons based on the most recent SPIVA Canada Year-End 2023 scorecard, as just one piece of proof of that fact. By the way, if we haven't ever met, my name's Steve Willems. I'm a wealth advisor here with the Willems Wealth Planning Group out in BC. We started this channel to help you plan for your own retirement, how to arrange your investments, your income streams, and ideally pay less tax along the way. Now, it's important. I want you to hear what I'm not saying. I'm not saying that CPP is bad. I'm not saying that we should split it up and every province has their own CPP, or even that the whole thing is going to collapse. It's not. It's just not fine-tuned like you should expect it to be. And so this naturally raises the question, what could they have done differently? What could have been improved? What would have improved the odds of higher performance and reduced costs? Well, this is where the lessons of Anheuser-Busch, that American beer company back in the 1980s, become relevant, because at that time, their pension fund was underperforming its own reference portfolio. All institutional pension funds do this. They track how they're doing relative to some benchmark. And they were lagging despite the involvement of very highly rated and expensive institutional investment consultants. These consultants frequently recommend new managers based on their recent performance, and they're going to hope to generate better returns by doing that work. However, time and time again, what they found was that these new managers failed to outperform their benchmarks as soon as they were hired. It was like as soon as they were hired, that performance benefit, it was gone. So this constant cycling of managers led to higher costs and disappointing results. And so after an exhaustive study, an internal group actually came to a pretty shocking conclusion. Shocking at the time, really, because no one else was thinking this. That no investment manager could or should be expected to consistently beat the benchmarks, and it was very expensive to keep on trying. Even more surprising was that the pension committee, they actually agreed, and they had the conviction to act on that evidence. They fired the consultant, they ditched the active investment manager strategy, and they invested all of the plan's money back into index funds, essentially. One member of this committee found the evidence to be so compelling that he changed his own personal investment strategy. He sold all of his stocks and his active funds, and he moved all of his savings into this passive kind of indexed strategy. In his own words, the impact was profound. Not only did he achieve higher returns, but he saved about 240 hours a year, which was the equivalent of about 6 weeks annually that had previously been spent just managing his portfolio. So while this shift was pretty revolutionary for Anheuser-Busch back in the 80s, today's investors and folks planning for retirement like you have even more tools and data at our disposal to make informed decisions. What do I mean by that? Well, there's at least 6 things that are better now than they were in the 80s. First, advanced data and analytics now allows investors to access just extensive historical data and to use sophisticated tools to make more informed investment decisions and to identify better patterns. The data is better. Second, the range of diversified investment options is expanded dramatically to include multi-factor funds and kind of quant funds that are going to leverage that data and then target specific market areas with historically better returns. Third, since the 1980s, increased competition has significantly driven down the cost of managing these investment strategies, and that directly benefits investors by improving their returns through cost reduction. Fourth, technological advancements have introduced a lot of these online platforms, maybe even robo-advisors that provide a lot of automated portfolio management functions like automatic rebalancing, tax loss harvesting, or even just tailoring personalized investment strategies, again at much lower costs. Fifth, investors now have unprecedented access to educational resources, books, podcasts, online courses, and all of this has the potential to help them understand and implement kind of evidence-based investment strategies. And then sixth, research in behavioral finance is also becoming more and more valuable as it's highlighting common investor pitfalls and it's allowing the development of different strategies that are going to minimize those emotional decisions and hopefully improve investment outcomes. Now, all of this talk about CPP and this American beer company, what does this matter for you? Well, you see, institutions and individual investors often fall for the same traps: performance chasing, fear, and greed. The difference, of course, is that institutions have to report their actions and their outcomes to someone else, just like this CPP report here was done based on the work that they did last year. And that can lead to pressure and often frequent changes in the strategy that they're implementing. As an individual investor, you don't have this obligation. This independence is actually your edge. I would wonder, what can you do that the CPP has struggled to do? Well, 3 ideas. First, just avoid performance chasing, period. Institutions, we can see they're frequently going to be changing managers based on recent performance. They're going to hope to capture their gains. This strategy, the evidence suggests, rarely works and often does come at a higher cost and lower future expected returns. So what you'll want to do is avoid this trap entirely by just sticking to a consistent kind of evidence-based strategy. Importantly, that you understand, you know why you're doing what you're doing, and it's going to have the data to show kind of pleasing outcomes over the longest amount of time. Second, just manage your fear and your greed, those emotions. Market fluctuations often cause fear and greed to kind of dominate our decision-making. Now, institutions are often driven by the need to report their results, and so they can often make hasty decisions based on those same emotions that we feel as individuals. As an individual, though, you can remain patient. You can choose to remain disciplined. You can focus on the long term instead of the short-term wobbles. A third is just what I'd call the edge of independence. Without the pressure then to report quarterly results or to justify the decisions that you're making to a board or to a committee, you've got the freedom to adopt that long-term perspective. And this is going to allow you to capitalize on strategies that institutions might overlook due to their need for immediate, fast results. So by recognizing these traps and leveraging your independence, you can actually have a more resilient and successful investment strategy, and will hopefully avoid the pitfalls that even these large institutions like CPP face. Because when it comes to your retirement plan, this isn't really an area where you actually benefit from having an overwhelming amount of sophistication. Simple works just fine. Yeah, I hope that helps you kind of connect the dots between Anheuser-Busch, this American beer company back in the 80s, and CPP's most recent annual report here in 2024. But what all of that means if you're here planning your retirement. If you'd ever like a hand reviewing the progress that you're making on your own plan, or even to see if you're on track, or if you're actually holding a bag of those underperforming expensive holdings, every week we set aside a few time slots to meet with folks who have those kinds of questions. If you'd like to take advantage of that, I'll put a link in the description below, and you can grab one of those times on the calendar. Otherwise, that's all for now. Thanks always for watching. I'll see you in the next video.